We do think he'll be softer. We don't think he'll be a headwind on the trade front. He'll be a tailwind over the duration of his 4-year term. We look at trade in broad terms, and there were tensions bubbling beneath the surface ahead of the presidential election in digital taxes that you mentioned, but also the 232 car investigation, steel and aluminium tariffs, the Boeing Airbus subsidies. All of those, we think, will be gradually de-escalated over the coming months, and that will pave the way, we think, towards a further trade engagement with the UK once the UK has left the EU. And we look forward to a US-UK trade deal during the Biden presidency.
Can I ask you about the UK stock market valuation? You've pointed out that it is cheaper relative to other developed markets, but we have seen a huge step up from where we were in October. Just talk us through some of the merits, because you also point out the dividend, and we know dividends have been cut and some of them have been restored. What are the merits for investing in the UK stock market at this point?
Well, just to highlight, the discount to the developed markets is at a 50-year low. So it's really significant on a low teens multiple. But when we look at the dividend story for the UK, it's about 3.5%, which is higher than any other developed market. But what is exciting for us is that we've had 6 months of dividend cancellations, postponements, suspensions, and that's coming to an end. More companies are looking more confident with the dividend outlook for next year and likely to resume. And we think that will include the bank sector next year as well. But what's interesting about that dividend yield of 3.5% is that it gives you a better quality total return for the UK because those dividends will be assured. And secondly, it's a really high dividend yield in relation to fixed income. That yield gap at around 3% at the moment is telling us that we're going to see flows from fixed income into UK equities in the months ahead.